Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 28th day of August, 2018. Before I talk to you about today's show, let me remind you that I am the editor of Jay Taylor's Gold, Energy, and Tech Stocks, and that you can subscribe to my letter by going to miningstocks.com, or you can call our office here in New York City during normal work hours, 718-457-1426, 718-457-1426. Would also like to encourage you to consider subscribing to Chen Lin's letter by going to chenpicks.com. Chen has done exceptionally well as an investor, having turned $5,400 into $2.5 million over a 10-year period. And now he shares his ideas with his subscribers. And better yet, today he's going to be with us during the second segment to share a couple of his biotech ideas and a couple of his energy stocks that he likes a lot with us as well. I should also just mention that it's OliverMSA.com. OliverMSA.com. Going to be with me again is Michael Oliver, and goodness sakes, he's been so helpful to us. Just write that address down too, OliverMSA.com. I always talk about it every week, but just make a special note because Michael deserves the same kind of attention. So I do want to thank all of you for listening to this show and making one of the more popular shows in the Voice America Business Channel. Also want to invite you to keep your questions, criticisms, comments, whatever they are, to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. We also want to thank our sponsors for making this show economically viable. Today's sponsors, RN Resources, Bonterra Resources, Genesis Metals Corp., Great Bear Resources, Klondike Gold, and Novo Resources. And I might just mention that last week about this time when I was talking to you about Great Bear Resources, the stock rose. It was selling at about 50 cents. It's $1.40 before the show began today. So in 1 week, it got above $1.50. So in 1 week, and that's in U.S. money, in 1 week it more than tripled. These are the kind of explosive runs you can get when companies come through with impressive drill intercepts. Klondike Gold, we'll be talking to Peter Talman next week, and I think they have similar potential with their Yukon project. Novo Resources, of course, the same thing. I'm very bullish on the junior sector. We've been millions of dollars put into this sector, drill holes put down. It takes a long time from exploration until results come. But now the capital that's been plowed into the ground the last few years, we're starting to see some results, and some of them are downright exciting. So I hope that you'll consider subscribing to my letter. We've got lots of great ideas, and some of them we'll share with you here on the show. I've titled today's show Long-Term Stocks and Gold Beat Long-Term Stocks and Bonds. David McElveny, Chen Lin, and as I said, Michael Oliver will be with me in just a moment or two. David will be second during the second half of today's show, and Chen Lin the second segment. You may not be aware of the fact that if you had a portfolio containing 75% stocks and 25% gold over the last 50 years, it would have performed substantially better than if you had a portfolio comprised of 75% stocks and 25% bonds. But that indeed is the truth. As we'll learn from David McElveny, he'll provide some ideas as to why that has happened and why it might make a lot of sense if you really understand the nature of gold. Specifically, just the numbers, more specifically over the last 50 years, a portfolio, invest $1,000 50 years ago, 75% in stocks and 25% in bonds, that $1,000 would have grown to $93,000. But if you had put 75% of that $1,000 in stocks and 25% in gold, that $1,000 would have grown to $125,000 over that same time period. And even better, the portfolio with gold would have been less risky. Fewer ups and downs. That's risk defined as volatility of annual returns. So we'll be talking to David McElveny about that in the second half of today's show, and ask him about what are some of the ways that investors can take advantage of that long-term dynamic. Also, Chen Lin will be with me in just a couple of minutes here after we talk to Michael. Chen will talk to us about two of his favorite biotech stocks, and that's where he's really made a lot of money in the last few years in the biotech sector. Also, he's done very well in the energy stocks and quite well also sometimes in the gold share sector. So Chen will be with us, but right now, Michael Oliver. Thanks for joining me, Michael.
Hi, Jay.
Always good to have you with us now. Last week seemed like kind of a pivotal, maybe turning point for gold. Mm-hmm. Today I see gold is getting whacked pretty hard. I haven't looked at it in the last half hour or so, but it was down pretty hard today. What's your take on gold right now?
I think everything is transitioning, and I think gold too. And I think the transition began in some markets over the last 2 weeks. That would be gold, for example, and dollar index, with gold shooting up as much as 4.5% off its low, intra-week low to the high of this week, and the dollar index dropping sharply over the last couple of weeks from an area I think is resistance, and I think both of them are making a transitional turn of their intermediate trends. The major trend on gold is up, the major trend on dollar is down, and so therefore the dollar rally we've seen over the last several months, which I think has peaked, is just an intermediate counter-trend rally, and the same with the large drop in gold from well over 1,300 down to where we've been recently, and I think that they're turning. Now, I think this is also true with a lot of markets. The S&P, for example, which I'm really focused on right now, which has probably got people more fatigued in the watching process than any market. The drop that occurred in February, we measure markets by different time scales of momentum trend. Everything breathes, short term, intermediate, long term. And sometimes these swings aren't in sync with each other. A long term trend could be positive and you'll have a counter trend move that may last several months, for example. Well, so we measure via different time scales. Well, in the case of the S&P in February, we had a sell signal at 2790. That was about 60, 70 points off the traded high of January. It collapsed within 6 days to 2532 from that sell signal. Now, that was an intermediate trend sell signal. It stopped exactly at a level that it had stopped at in the Brexit sell-off and the post-Trump sell-off, which is its 40-week moving average, or for on our oscillators, a zero line. It stopped there. Now, there was so much distance between the point where intermediate trend signaled a sell and where it got down to a level that needed to hold on long-term momentum, that by the time you got to the long-term momentum number, you were pretty much exhausted on near-term and intermediate-term charts. You were oversold. So it held. So the problem then, in terms of turning the S&P into a longer-term bear, was you exhausted yourself just getting down to the key structure. That's changed. We've come back. We had about a 6-day drop in February that collapsed hundreds of points. It's taken us 7 months to regain all that. So consider that, days versus months. And finally made a new high. Oh boy, we're now, percent above the January high. Okay. It's non-confirmed on all momentum indicators, and the pending structure to break it back down on an intermediate basis starting in a week in September are numbers literally around where you're trading now, down to about 1% below where you're trading now. So there's a minefield right below the market. Now, the difference this time between now and the February break is the long-term breakage numbers are only 3.5% below where you break the intermediate trend. So unlike in February, when there was a huge distance between breakage of one and then breakage of the other, almost 10% or more, this time it's only 3.5%. So the minefields are very close together this time. And therefore, I think you've got to be watching the S&P, because any intermediate downturn that we can signal, and we issue them in our reports, all it has to do is sneeze 3.5% more beyond the point of breakage, and it's going to trigger the big stuff, in which case you probably got your top. And it was the big stuff. Yeah, this is stuff that goes. This trend support structure I'm talking about on long-term momentum goes all the way back to late 2016, and it's been used so many times it's ridiculous. If you saw the momentum chart, you would say, "Oh my God, this is highly dangerous. You can't break that level again. If you ever do, you're over." But I think all of this is occurring in various markets simultaneously, where the transition points are occurring. Some of them have already begun. I think the dollar down and gold back to the upside. And no, it's not going to be a straight shot. But I think you're going to see more evidence of it as we get into next month, because that's when the monthly numbers take over, and I think you're going to see the trend change will be a little more apparent. Upside in gold, upside in silver, and downside in the dollar, and likely downside in the S&P. So I think we're in transition right now. It wouldn't surprise me between now and first of next month, which is Tuesday, a week from now, that you get some downside in the S&P, some kind of sell-off, but nothing significant. It's when you get into September that the numbers get really pregnant for these reversals, and so and I think it'll be largely concerted. It'll be happening in many markets, both different directions. So.
We'll have to wait and see. I certainly. One of the things that I really like about your work, Michael, is it helps to put in perspective these. We tend to be influenced so strongly by what's happening in the near term, and we don't see the world from 30,000 feet up. We see it from right where we're at. And so today, for example, I'm seeing a cash gold down 1160 right now. It's just a whisker under 1,200. And, it was looking very good early today, but lo and behold. But that's the way markets are, and what you seem to do and what's so helpful to me is put these short-term things in perspective from the longer term. The structure, longer term, shorter term, these counter-trend rallies and so on and so forth, very helpful to me. And anything else you'd like to add this today yet before we go to the break?
No, I even see it in the grains, which we fumbled on that one, I have to admit. We saw the grains as upside earlier this year, and then wheat, in fact, has gone up. But corn and beans went down, and it was the tariff ambush that occurred in May when the Trump tariffs against China, because China's the biggest consumer of soybeans in the world. And he says, they stuck a tariff on it to retaliate against his tariffs. And so the soybean market really got whacked, and it's down, in my opinion, at what's called theoretical zero, meaning commodities aren't going to go to zero. So each commodity has a level over time, and it gradually rises because of the decay in the currency units, obviously you measure it by, where a certain price level is just not going to go below there. It'll labor there, but it's telling you, I've had it. And I think around $8 beans is around theoretical zero for soybeans. Each commodity has its own sort of ground floor that you can beat it back down there, but you just aren't going to take it lower because it's not going to go to zero. And I think we're about there in soybeans. I think the monthly shift that we're going to see in the grains next month is also going to become apparent, particularly in corn and beans, back to the upside.
Okay. I know you've been particularly bullish on the grains, on the agricultural commodities. With 30 seconds left here, Michael, do you still see... Do you see a possible counter? Do you see an end to the decline in copper and oil, and possibly a resumption of a bull market in those two markets?
Yeah, the oil I'm a little mixed on. I kind of think that it could ratchet itself lower between now and the end of the year. I think it had a glorious first 2 years off its low after it went from $26 to $75. I mean, not many commodities had that percent recovery. So I'm sort of ambivalent on oil right now. Copper may have had the correction we wanted. At $3.16, which was slightly off the highs back in May, June, we said, a sharp correction's coming, probably into the 250 area. It got to 255. Right now it's 273. So that might have been the corrective low at copper. But,
all right.
Yeah.
Still bullish on commodities in general, and yes, and yeah. All right, very good.
Despite the fumble in the grains, the tariff news and all that, I think they can overcome that and regain themselves. But I think it's transition month is September. We used a phrase, sumo wrestler pivot throw. You've seen a sumo wrestler pivot throw the other guy. I think that's going to happen in a lot of markets during September.
All right. Well, that's another thing that's fun about reading your stuff, Michael, is you do use some picturesque language from time to time, and that's to make otherwise boring numbers look a little more interesting.